I will be talking this morning about Fibonacci and trading waves, combination of those two. We've had some real interesting times in the market, and there are so many tools that we can use to help us with our analysis. And what is most important is turning that analysis into something that we can actually trade. One of the big problems with analysis is such a broad area. Having mentioned there are so many different tools that we can use, what we've just got to always keep in mind is that analysis doesn't actually make any money. It's the trading that makes the money. So it's a question of turning the analysis away from purely an academic exercise and into something that will make us money and hopefully do so on a consistent basis. So analysis paralysis is one of the big problems that all traders have. They look at this method, they look at that method, and butterfly from one to the other, and don't settle on a set of analysis tools that can be used to actually help them in their trading. Well, I use a number of things. Now, I do blend things together, and the two most important ones for me are Fibonacci with candlestick analysis, and then the third one is trading waves, plus one or two straightforward basics of support and resistance and so on. So let's get started. First of all, let's just look at the theory of Elliott Wave. Now, R.N. Elliott, a good many years ago, he was an academic, and he started to see waveforms in all sorts of different things. And of course, the markets was one of those that he saw it in, and he observed these waves. Now, the waves that he observed were a series of 5 waves, the most important being the 3 waves, which he called impulse waves. So let's just run through on these. What have we got? We've got impulse wave 1, and then there's a corrective wave. Then we get another sharp wave moving on up, impulse wave 3, and then there's a corrective wave, which is going to be wave 4, and then finally the whole thing comes to an end with wave 5. Now, but just put a comment down here at the bottom left. It doesn't matter why, just use it when you see it. Now, why do we get these waves forming? Well, there's just this whole process that goes on in the markets all the time of those who tend to be dominant for a period of time. Hence, you tend to get these impulse waves. And then, of course, there's going to be a number of people who then decide, well, they're going to take profits at this stage, and there are going to be a number of others who say, well, no, I just don't believe that that impulse wave was the correct move, and they will actually just be selling into it, expecting the whole thing to move on down. So we tend to get this process of backing and filling that is just the nature of the beast that we trade very well every day. So what happens at the end of this? Well, what happens at the end of a series of 5 waves, then there are going to be corrective waves, and typically we're going to see an ABC type correction, which is the Elliott Wave method of talking about corrections, ABC, and then after that, what are we going to get? Well, we could well then get a whole new wave count that actually develops, all waves within waves, and let's just seek to explain some of those as we go through. Now, of course, it doesn't just work in up markets, it works in down markets just as well. And here we are, we've got markets moving on down. So we've got exactly the same thing happening, but just entirely in reverse. Impulse wave on the downside, wave 1, corrective wave 2, big wave 3, which is more or less the norm with Elliott Wave, corrective wave 4, then down for 5, and then of course, there we are, comes to an end with an ABC. So let's just consider the rules. Now, the rules are very, very simple to follow, and they're simply this. Firstly, after impulse wave 1, then we want to see a corrective wave, but it does not want to close below, and I emphasize the word close, it does not want to close below the start of wave 1. Now, I quite often see very, very deep retracements, and when we link it up with Fibonacci, we'll see that. But the key thing here is that we do not get the close below the start of wave 1. Now, wave 3 is going to move on up, and then it's going to correct back with wave 4. Now, wave 4, again, in common with wave 1, it does not want to close below the peak of wave 1. Okay? Now it can do so intra-bar, or intraday, or intra 5 minutes. It works on absolutely any time frame. Depends just which time frame that we're analyzing. And then wave 3 is usually the longest wave. Okay, usually the longest wave. And so often, and as we'll see in a moment, these waves, particularly the impulse waves, we can see these now divided up into a series of waves themselves when we look at the lower time frame. Wave 5 is very often the shortest wave, and wave 5 is very often related in terms of length, or in terms of vertical distance traveled, I should say, to impulse wave 1. So there we are. I've alluded to the fact that waves in one time frame can have subdivisions of waves in a smaller time frame. So let's just assume that the red line here could be a wave 1 in a larger time frame, and let's just assume that it's a daily, a set of daily charts that we're looking at here, and we see it moving up on the daily, corrects back. Now that could be wave 1 followed by corrective wave 2. Then the red wave here that we can see could well be wave 3. And then if we look in the smaller time frames coming down to, say, at 15, then what we just might be seeing there is a subdivision where we can divide that one wave into 1. Excuse me a sec. Down, and then we have a corrective ABC. Fine, good. All seems to be well. We were just looking at the main rules. Let me just quickly whiz through those. Impulse wave 1 is followed by corrective wave 2. And wave 2 does not want to close below the start of wave 1. Okay. We then have usually a long wave 3, usually the longest of the waves. And corrective wave 4 does not want to close below the peak of wave 1. Okay. Now we may well get some intraday or indeed interbar activity that will encroach on the peak of wave 1. But provided we don't get a close, then we've still got the potential for a valid wave count and for the potential for a fifth wave to move on up. Now, what can be really quite useful for analysis is that we are likely to see, if we're looking at the red wave here being in a longer time frame and the black being in a shorter time frame, we can relate one to the other. So in this case, we've got wave 1 going on up, which we may well be looking at on daily charts. And then the black, we can then see this one day subdivided, if we're looking at, say, the 15-minute chart, into a series of 5 waves. And very, very often, the corrective wave 2 that we can see here in red can be subdivided into 3 black waves, A, B, C, and so on. As you can see, we've then got red wave 3 here appearing, and we then have wave 1, 2, 3, 4, 5. So with the subdivision of waves, then it can give us some fine-tuning to turn the analysis into a practical trading tool. So the optimum time to get in on any trade is at the start of a wave. And we're looking here then at the optimum of the optimum, which is to get in at the start of wave 3. And by just looking at what has been going on here with the corrective wave 2, which will very often come down to a Fibonacci level, may well also provide some candle evidence that it's turning the corner and going back in the direction of wave 1. If we can get in at that point, then we're going to absolutely maximize our profit potential, provided, of course, we can get out at the right time. And this is where the subdivision of looking at 5 waves in the smaller time frame, assuming that we can count 5 waves having moved on through, then that can give us the heads up for the right point to actually close our trade. Now, when we were just off air for a moment, I did just mention that there is a rule of alternation. I'm going to just throw that into the melting pot right now, in that the corrective wave will quite often, as we see here, subdivide into an ABC with 3 waves, but sometimes you will see them subdividing into 5, A, B, C, D, E. And the rule of alternation suggests that if this corrective wave 2 subdivides into 3 waves, then the next corrective wave, which hasn't formed yet, the next corrective wave 4 is most likely to subdivide into 5 waves and vice versa. Okay? So that is another little rule that can help us. So that if we see a 3-wave correction here, most likely we're going to see a 5-wave correction with wave 4. So I'm just now circling and putting arrows on the areas where we really do want to be putting our trades on. So they are going to be the optimum areas to actually get in and get out. So let's just look at this as a series of waves within waves. This is a long-term chart. As you can see, it's the euro against Japanese yen monthly chart. And we've got a wave 1, which you can actually see subdivided into a series of waves. And then we've got a little corrective wave 2 subdivided into 3. And then we've got a very, very long wave 3, small corrective wave 4, following the rules, does not close below the peak of wave 1. And then it goes up for a very, very small wave 5. Now, this is so often the case that wave 5 attempts to go higher and then just about caves in and then falls over all the way on down. And as we can see, that's exactly what happened there. It collapsed really quite dramatically. Now, one of the most useful aspects of the process is to spot a measured move, which is very often part of an ABC correction. So what we're actually looking at then is that we've got let's assume that this red move down, the red move down here is part of the main trend. And then there's going to be a correction. What will so often happen is that we get a correction moving on up for an A, then it comes down for a B, turns the corner, and then moves on up again. And what I like to do is to catch these wave C's after wave B has just worked through wherever it's going to work through to. And the vertical distance traveled of C is so often related to wave A. If it's 100%, it's called a measured move, but very often we find it's going to be a Fibonacci multiple. It might be 61.8, it might be 78.6 or 138.2 and so on. So this is what we're most likely to see then. We're most likely to see then from a major move down, we're going to see a correction, and these counter trend trades can be very, very useful. So for those people who are looking at probably Elliott Wave for the first time, then what I'm looking at as one of the easier ways to trade Elliott Wave rules is to look for something that appears to be a trend that's kicked off, and then let's look for the correction. So we're looking for this move on down. At some point, it's going to run out of steam and correct on back up. If we can actually see what is going on with this correction, and then we can see that the A wave has caved in and the B wave has now formed, which is a little correction of the rally here. If we've got some evidence there at the blue line, and my entry, absolutely, it's going to be at the end of wave B. That's where my entry is going to be And I'm going to want a little bit of evidence there. Ideally, this blue line is going to come down to a 50% Fibonacci, might be a 61.8, might even be as far back as a 78.6, with some candle evidence, such as this little B wave may come to an end with a hammer, or maybe an engulfing candle. That would be my trigger, or at least the candle that came after that hammer or engulfing would be my trigger to actually get in. And then I'd be looking as a target the distance, the vertical distance traveled of A. I will be looking to then close part of my position when it got up to that same level. So that's one of the safest ways to trade Elliott. And as one becomes a little more competent and you start to see these things, then moving on to the main wave pattern itself. So let's just look at one or two examples. Now this one is a market which is so closely related and correlated to Forex that many traders will trade gold as a proxy for things like the dollar index, where we've got an A move, a B, and then we've got the C, which actually moved on down. It's 100%. The BC move was 100% of A, and look at that. Sure enough, it comes down to a support area, which also happens to be the 78.6 fib line. So let's just consider some of these fib ratios for a moment. Sorry, let's just go back. Right, now, this is a trend here. I've not got a clear point for, but this is the trend which is moving up. Price then comes on down on this ABC corrective move, and then ideally what we're going to be doing is to trade from point B down to point C, and then from point C hopefully we're going to get in on this next move up, and there are a number of narrow range candles there that would enable that, and then this just may well be wave 3. Now we never know this, and you're quite right, Haribo, this is a harmonic pattern. In fact, the Gartley pattern and the bat pattern are two very important ones. And this is a Gartley. So you can sort of start to link quite a few things together here. And the standard objective for a Gartley is going to be the old high. And then from there on, it'll be Fibonacci multiples thereof, which can, of course, develop into a major 5-wave pattern. So these deep retracements are those that I do really like. So fib grids, fib ratios, standard ratios, 61.8, 38.2, plus of course 50%. I also use 23.6, 70.7, but most importantly 78.6 and 88.7. And I use these both with retracements, extensions, and also expansions, but the expansions aren't quite so important. So there we are, I've got a fib grid just showing there where we've got a dominant move on down, and then there's a sharp retracement back. And of course, and we just don't know this before we've got a completed 5-wave pattern, 85.4, there are a whole stack of them, then this could just be wave 1, wave 2, and then if we can catch it at 78.6 as it turns the corner, then that could be the start of a really, really big wave 3. So we're in the land of sort of conjecture when we're looking at the start of these waves, and it really is a question of just considering that it could be developing. And of course, nothing is cut and dried until the end of a wave count. But of course, at the end of a wave count, if we haven't actually put a trade on, we can't make any money. So there are times when we've got to make an assumption based on what it is that we can see. Now this just happens to be another one here where we've got an ABC move. Moved down, this A move ended with a hammer, popped back up to the 61.8% fib, and then it went down for another swing. So we've got the C swing being exactly the same length as the A swing. This particular one on the Swissy, Swiss franc, US dollar, Swiss franc, I should say, we've got the A move, comes back for a deep correction down to 78.6, and then it moves on up, this time going beyond 100%, and it's gone up to 123.6%. And it ends with, well, an FBR, false break reversal. You can see where we've got 1, 2, 3 candles. Okay, we've got 3 candles there that look very much as if they could become a double top, but no, price does take a little pop above, but then it turns out to be a false break, and back it comes. Right, so let's just move on to, this is a 15-minute chart, the Australian dollar. This is where we've got an established trend. Over here on the left, we had a preceding uptrend. That changed as one of the preceding higher lows was violated, was taken out, and then in this area, the trend is now established as it breaks on down through. And here we've got a series of waves. So we've got down wave 1. It retraces up to a fib line of the last wave. That's 50% of the last wave down and 38.2 of the full wave. The next wave moved down, and you can then see the subdivision of that. Then it popped back up for a corrective wave 4, and then wave 5 runs on down. And that just happens to be exactly the self-same length as wave 3 in this case. Price then bounced on back up. Where did it go to? Well, more or less up to the 50% retrace, but then it came back down again for 50%, and then what did it do? Measured move all the way on up. Where did that go to? 78.6. So what we've got is a 5-wave pattern coming down here. Yeah, absolutely, Harina. It's a head and shoulders. So again, let's link a few bits of evidence together where we've got this previous trend moving on up. Then that's the head, got a left shoulder, got a right shoulder, and then as the neckline is broken, then that does confirm the new trend. So the retracement that we've got now being an ABC type measured move retracement would have provided the trader with an excellent opportunity. And just look at the time frame here for European traders. European traders there at that 50% would have a wonderful opportunity to get in and trade the C part of the measured move. Okay, on up it goes. And then, of course, what happened? It caved in at 78.6. For yet another fib move down to a 61.8, which is taking from just above the 78.6 here, this end of the measured move, from the preceding low. Yeah, I'll get back to those rules, Boyke, just before we close. And so what do we got? We've got a lot of Fibonacci here, and we've got a lot of waves, which are just following through. So price then moved up to 61.8, and eventually then it just absolutely caved in. Now this pattern did go on to develop, and it moved into a major 5-wave move, looking at the larger time frame. But as you can see, coming down to the 15-minute time frame, then we've got a series of highly tradable waves. So let's just look at cable for a moment. Just going back a little while on cable. Are the waves to be seen? Well, here it is right down at the lows, and then it moves up for a pop above the preceding significant lower high. So the trend looks very much as if it's going to attempt to change, comes back for a correction, and then shoots on up. So here we are. I'm putting these waves on, and these waves are now suggesting that what we've got is a clear series of waves. Now I'm just going to put this portable fib grid on. Okay, now hopefully you can see that grid quite happily there. And price then corrects back down, and it corrects back down to the 50%. Now, let's just relate one wave to another. And what I so often find is that wave 1 and wave 5 is actually related. So there we have wave 5, which is virtually the same length as wave 1. Right now, couple of points then. If we've got a minute, if we can overrun, we'll take a look at the Euro, USD, etc. And yeah, I mean that of course, Jez, is one of the big problems with all analysis and methods, systems and processes, is that it can look incredibly simple, but we all know that life is not like that. We all know that life is considerably more complicated than what we're just plainly looking at. And of course, what I've got here, I've got hindsight that we're looking at. But when I'm actually trading this, and assuming that I'm sort of trading the waves, and what will actually get me into a trade is when I see a wave 1, which has a peak which is above a previous lower high. So assuming that we've got a downtrend, as we did well have prior to this, then it's giving me the heads up that I want to get in on this trade. So I've just got to wait for this wave 2 to work through, and it's entirely possible that I would get in and I would be going long, and I would be going long after I've picked up. I might even have a few false starts along the way, but provided I can get in really early, if I'm going to be taking a stop loss, then that stop loss is going to be a very small stop loss, and then I sort of move on up. You know, I may well have been quite keen on getting in as well on this engulfing, in which case, provided that I put my stop at a sensible level, which is down below this correction, then throughout this whole thing, I would have been safe. Now, it's entirely possible that this little correction down here might have just popped my stop loss. Well, if it did, well, so be it. I then look for a little bit further evidence that it's not going to go down any lower. And the fact that it did not pop down below that previous low tells me that. And then I'm looking for a narrow range candle, and I've got it. It's that little red candle just down here at 153.40. As that little narrow range candle is actually broken on the upside, then again I'm going to trade. Now, at that hard right edge of the chart, at that time, I had no idea it was going to go on up through several hundred pips. But that's what did happen. I say several hundred pips. It went through about 120 odd tradable pips there. And, the trader has to make these leaps of faith. And the leap of faith is based on as much evidence as we can gather. But of course, the important thing is not to wait too long. Waiting too long means that we're going to get into a trade far too late, and that can cause us some problems. So I'm blending the analysis here. I'm blending the analysis with some aspects of Elliott Wave. I'm using the ABC approach. I'm also using Fibonacci, and I'm using candle analysis in order to fine-tune my entries. Now, this is on a 5-minute chart, and I will typically trade off the short-term charts, coming right the way down to even a 2-minute chart. And but I will be looking at the larger time frames in order to help me identify where the waves actually are. Now, guys, I've just come to the end of that particular presentation, but I'm quite keen on maybe looking at some charts. If we are okay just to overrun a little, let's just do that. Bear with me while I just bring my trade station back up, which just needs to be fired up here. Station to look at in a second. Right, well, as I mentioned, the dollar index is the game in town, and it looks very much today as if we're going to have a new high formed, which is more or less there right now. Now, just down below here, I've actually got the ATR, which at the moment don't really need, so I'm just going to knock that off. And let's take off one or two of these lines. Now, I tend to, as I'm trading, I draw in the lines. Now, you can probably see that I have got, with these little blue lines, I've got the waves drawn in. And what I've actually seen from the, oh dear, right, let's have another go. So you can see that I've got these blue lines forming, showing these series of waves. So we've got wave 1, got a corrective wave 2, and wave 2 did not come down terribly far at all. It came down to round number here at 77, and then on up for a potential wave 3. All of these are potential because until the whole thing is formed, we never really quite know. But then it came down for a corrective wave. Now, how do you trade this? Well, you trade it on the basis that you've seen a previous downtrend, which has been a really, really strong downtrend. It then clearly comes to an end. And it comes to an end, and there are a number of things that will tell us that it's come to an end. The fact that price then bounces back up and it takes out previous lower highs. Okay. We could draw a trend line down from the previous trend. That is broken. It then forms a higher low. This higher low is formed here at 77 with a narrow range candle. What's the trader to do? Well, you see this nice little ABC type correction back to a round number, and the trader is going to see that little Hallmey, which is an inside candle smaller than the preceding one, and then price bounces up out of there. The trader has just got to go long with a stop just below the low. As it moves on up, stop goes to break even, protecting profits. And then what do? We see yet another correction that comes in. And the correction comes in, and this has been one of these, it's a fairly complex one where it went up to a new high. Of course, that had the possibility where it went up to a new high just above my white line there, that this whole thing could have crashed down. That could have been a completed 5-wave count. But it retraced an awfully long way down. Yet again, it's one of these harmonic patterns that had similarities to not quite a perfect Gartley pattern, not quite a perfect back pattern, but had the similarities of the two. Where did it go on up? Well, it went on up and it formed a new high. That's the first target area. But we now are on a roll, and it looks very much as if we're going to see a 5th wave. Now, where is this 5th wave likely to go? Well, let's just move out now to a weekly chart, and this might just help somewhat. Let's put on some Fibonacci. Let's now compare this potential wave 1, okay, well, let's call it a wave 1, with the start of wave 5. And we've got some Fibonacci extensions. Now let's just look at a retracement, and a retracement of the last swing down. That was that really deep swing down. And price is going to move on down to there. Now, what I find most useful is that we want to take the fib from the deep retracement that there was. So we're going to take fib on the swing. And areas where there are a number of fibs actually coinciding, and here we've just got 2. We've got a retracement and an extension. 61.8 and the 50% did cause this a little bit of a problem. Price previously popped up to there, it rocked up to there, and then just walloped on back down again. It just wasn't enough momentum to push it on. But it's now found that momentum coming out of this deep, deep retracement here on the way down to 80. And it's absolutely catapulted the thing on up so that we're going to get a new high today. Where is it likely to go? Right, well, let's just link together various aspects of analysis. First of all, I've got an expectation that we're probably going to see 100% here, up around this 84.42 region. That would be 100% of wave 1. It links up with my Elliott Wave analysis. Number 2, 61.8 retracement area is where I guess the price is most likely to go to as well. And then I'm just going to move this little white line that I've got here, and I'm going to put it right bang in the middle of those two. And where my pointer is just now, in this region of 84.40 to 84.50 to 84.60 to 70, in that region, there is prior price action. There is an area that was prior support. And that area of prior support could become resistance. Let's look even further left, going right the way back to 0708. And in this area, there was some support, there was some support, and there was some resistance. So that, to me, 84.50 region is particularly important, and I wouldn't be at all surprised that that is where we're going to see, at the very least, a pause in this potential wave 5 that is moving on up. So that's just how I'm linking the analysis together. Now, just looking in the crystal ball, at the crystal ball, and that's really what I'm doing with this combination of Elliott Wave and Fibonacci analysis, then is that actually going to help me in my trading? Well, it just might help me hold my trade longer than perhaps I might normally do so. So let's just come back to the daily. On the daily, there has been a good swing here. It's moving on up. It's moved up from this 80 region now, more than a couple of hundred pips. So those traders who actually got in somewhere in this current wave could well be thinking that, oh yeah, look at this, I've got a whacking profit now. It's in this region of 50, 60, 61.8. Should I be taking profit? Well, the name of the game is actually taking profit. So my approach is to take partial profit and then hold a remaining part of the position and hold it to let it run through to areas where there could be a reversal. And that area of a reversal is where it could be 84.50, where we've got that confluence of fibs and indeed support and resistance. So that's my approach on trading. So let's go and look at something else. Let's take a look at, let's just, before we look at what everyone is looking at the moment, which is cable, I want to take a little look at the British pound against the Australian dollar. Now, British pound against the Australian dollar, let's just look at what has been going on here. Just look at that for a downtrend. Now, I'm assuming that you can see this, guys. Can you just confirm that you can now see British pound against the Australian dollar, please? Great. Thanks, Marina. Thanks, Marina. Right, now I'm just going to roll this out to a weekly chart because this thing has been moving down like crazy. We've had a period of time and the fundamentals tell us that the Australians have got a booming economy. They've not got, their banks haven't got caught up in subprime, toxic assets and so on in anything like the extent that US and UK banks managed to do. So we've got this booming economy, selling a whole load of aggregate, etc., to China. They've got a booming housing market. They're now starting to get some labour market problems. And of course, interest rates have been going up, as one would expect with a booming economy. So in all that time, cable has been just decimated. I mean, British pound, it's all over the British pound. Anything we read in the press, we can just look at more or less any article, and it's telling us that UK PLC is shot to pieces. Now let's just look at a little bit of ABC work, Elliott Wave. What have we got? First thing that really has sort of hit me between the eyes is that we've got a measured move. We've got a down move, it corrected, and then it went down for a really strong move down to exactly 100%. So we've got a nice little wave formation there. This down move, 5 waves, 1, 2, 3, 4, 5. The fifth wave will relate to wave 1. Well, there we go. It came down not to 100% of wave 1, but 61.8. Another little bit of Fibonacci evidence that is sort of, it got my attention. It got my attention. And what is actually happening right now? Well, let's come back to the daily chart then, having looked at this. From 170, we get an acceleration of the down move, which left a gap behind. It left a gap behind. And then what do we got? We've got this long, lazy sideways move, which has yet to be resolved either up or down. Now, it's probably going to wait until next week after we've got the election results for this one to be worked out. But I'm now linking several things, and I'm linking the fundamental to what I've just been looking at with those waves. And the fundamental for me is the exact opposite of what I've just been arguing. Right now, with this booming Australian economy, how much more can it boom? How much more can it boom? We read on the weekend press that the Australians, the administration has decided to increase taxes, corporate taxes. They are doing it in such a way that it's probably going to be somewhat muted, but they've been suggesting that just maybe taxes really ought to be increased because multinational companies have been making so much money out of the commodities boom that they want some to come back in taxes. Well, as we know, whenever in a free market you increase taxes, it can start to have a detrimental effect on that economy. So I'm starting to argue, or at least I'm starting to form the opinion that maybe Australia has got a long way to fall now in economic terms. And I'm also suggesting that just maybe, the problems with the British pound have been completely overdone. However, we've got to wait and see if what we're seeing here is just a short-term correction or something that is going to really bounce on back up. But Jez, yeah, I'm really saying that. Yeah, I'm saying that it's quite possible that we will see after an ABC correction, then we're going to see a new wave starting, and that's really, I suppose, the nub of what I'm looking at with my sort of short-term trading on the Elliott Wave. Right, okay, let's move to let's just move to cable right now, and just look at what there is going on here. Now, what have we got? Well, we've got a series of waves that have moved on down. We've got, you can count these waves sort of moving on down. We've moved down to this multi-point reversal. Price has actually popped up, and right now we're stuck in the middle. So there probably is not a tremendous amount here to really get me totally excited. It looks very much as if we're within this wide trading range that we've got. There's the potential now for maybe, we've rallied up to this sort of round number yet again this morning of 152. 152 has provided a lot of support and resistance in this area. Wouldn't be at all surprised that we'll see a little pop down to 150 with the strength now that we're seeing coming in with that dollar index. And that's the most likely scenario, I feel, here, that we're going to see lower levels, and that may well follow through onto the euro. But I'm just going to switch now to a real short-term 2-minute chart, and hopefully if you can confirm again that you can see this 2-minute chart on cable, please, which has got a white background this time, changed somewhat from the preceding one. Brilliant, thanks Marina. And I'm just going to put a little bit more data on here, just to show the trade that I specialize in, which is the breakfast trade. Having come here from 6 o'clock, walloped all the way on down. Now, can you see some waves here? Well, I most certainly can. I can see A, a B, and a C move on down. I can also see that this C wave is really quite neatly subdivided. Sorry, I can see, telling you incorrectly there. Let me just draw these in. I'm looking at the wave that comes on down here, wave 1. I've got a wave 2. I've then got a wave 3. A wave 4. And I've got a wave 5. So I've got 5 waves moving on down. And what so often happens with cable, it pops through a round number, 152 in this case, and then what has it done? It's bounced back up. 152.10, well, it's popped up to resistance. Pop the fib grid on from that preceding high. Where do we find? 61.8 to the pip. This is a 2-minute trader's chart. And there are so many tradable opportunities on this chart where do we start? Well, there's one just here from that 61.8. Got a nice little narrow range candle, Hallmey break, on down price goes. Where does it come down to? Well, it finds some support around about these previous lows. So at the moment, we're moving sideways. But as you can see, there was this brilliant move, which was not worth 100 pips, but it was worth around about 80 and 90 on this move down from 6 o'clock this morning until 9:30. And it ran through in a series of waves. And this series of waves then have proved to be very, very profitable waves. So at the moment, I'm flat. But consistent with what my view is on the dollar index is that the dollar index is going to go higher. Well, if the dollar index is going to go higher, then what's going to happen to the British pound? It's going to go lower. It's going to go lower. So my slightly longer term view from being completely flat is that we're probably going to see 150 before we're going to see 160 without a doubt. So I'm not short, I'm not long, I'm not suggesting to anyone that they should be one or the other, but just the balance of probabilities based on the waves and what is actually going on with them right now is that dollar strength seems to be the most likely scenario, and cable weakness is also most likely. But if we then sort of consider other markets, such as what is going on with the euro, and let's just take a look at the euro right now. Let's move away from that short-term traders chart. Let's move over to the euro. Bearing in mind that the dollar index that we've been looking at, the dollar index is something like, and I can probably be corrected here, around about 53% weighted in favor of the euro. So the euro makes up more than 50% of the movements of the dollar index. So it's correlated to that degree. We've seen the euro move on down, and of course we've got to get markets like the euro moving down to allow the dollar index to move up. Now, one of the other questions I'm frequently asked, which one drives it? Does the dollar index drive the euro, or does the euro drive the dollar index? Well, it's got to be the euro driving the dollar index, because this is the individual tradable currency, and it makes up more than 50% of the actual index itself. And of course, this has been moving on down, and as yet, I do not see any clear sign that the downtrend is actually stopping. Now, there are one or two areas along the way, and 135 was one of those emotive round numbers. The next big emotive round number is 130. So are we going to see price drop down to here? Highly likely, I would have thought. And 130, we look left, pop in a line, and what have we got there? We've got an area where 130 provided some support previously. Over here, it provided support. Over here, further left, it provided some resistance. So I wouldn't be at all surprised that we're going to see some area there of support in that 130 level. But of course, that support exists all the way down to 125. So supposing that that dollar index is going to reflect what's going on here, we could well see this one move down even somewhat further. And of course, just at the moment, the fundamentals that we know about are suggesting that maybe the euro has got further to fall. Is it indeed going to break up? Well, that's for longer term conjecture. But at the moment, just in terms of what is going on with the waves, it's moving on down. Now, let's just build in some waves here to what is going on with this weekly chart. And we've got a wave 1. Let's just pop in a wave 2 for the correction. We've then got a wave 3. Okay, that brings us down to here. And of course, there are times when you're going to be looking at the waves and think, well, quite where does wave 3 actually end? Well, I'm not going to draw in. Let me just not draw in the next wave. But let me just take wave 1 and project it on down, and where wave 1, supposing it did complete 100%, then that is down here below 130. Let's do a couple of other things. Let's just put on some Fibonacci. And that projected area is down there around about the 78.6 fib mark. So I will be actually getting really quite interested if the euro can get down to this level. We're looking at on a weekly time frame here, but if it got down to this level, you betcha there are going to be some opportunities here on the daily, on the hourly, on the 15-minute, on the 2-minute, coming right the way down the time frame. And this is an area where I guess we are most likely to find some sort of fairly strong bounce creeping back in. So there we go, guys. That's just taking a look then at a series of charts, looking at waves, relating them to the analysis, and then using the analysis to actually put some trades on. So, Haribo, just in terms of your lowest time frame, I'll come right the way down to a 25-tick chart to trade if necessary, but generally it's off a 2 and 3 minute chart. Right, now just finally, I did say that we would go back to the PowerPoint presentation briefly and look at the rules again. Bear with me. And hopefully, guys, you can now see the slide with wave rules. Can you see that? Fine, that's great. Rivo, yeah, in just answer your question, you're quite right. The spread will eat up your. So when we're trading, we've got to take into account a whole series of things, not just those technical aspects, but we've got to take into account what our trade management is going to tell us. And if we're going to trade something which is only going to provide perhaps a 20 pip return, then it would be crazy to go and trade something with, say, an 8+ pip spread. But if you can trade something with a 1 pip spread, then what we're actually looking at is something like a 5% spread, 1 out of 20. Anything more than that, and then we're going to be on a hiding to nothing. We're going to be making money for our broker, and so we've clearly got to take into account such things as that. So there we are, wave rules. Just to reiterate these, we've got an impulse wave 1, followed by a corrective wave 2, which does not want to close below the start of wave 1. We've then got an impulse wave 3, followed by a corrective wave 4, and that corrective wave 4 does not want to close below the peak of impulse wave 1. And then impulse wave 5 is usually the shortest wave, not exclusively, but usually the shortest wave, and it is very often the same length or the Fibonacci multiple of wave 1. Okay? And then I just threw in that where we've got corrective waves, that we can very often see relate the longer term waves to the shorter term waves. So we might be looking at the daily, and then we can then compare it to, say, the 15-minute chart, and we can quite often see things like a corrective wave 2 here in this case, can be subdivided into either 3 or 5 waves. And finally, that rule of alternation is that if wave 2 is subdivided into 3 waves, then wave 4, when it forms, is most likely to subdivide into 5 waves, and vice versa. So if wave 2 had a 5-wave correction, wave 4 is most likely to have a 3-wave correction. Okay, guys, that's it for now. If you want to find out more about these things, then I'm going to just mention a web address to you. And that web address, bear with me half a moment, let's just see if we can find this. is clickevents.co.uk, and you can see more about us there. Okay, guys, thanks so much indeed. Glad to have been with you. Glad we got the technology sorted out and it worked out, and also that my rather croaky voice managed to survive. See you again soon, guys.